Twin Cities homebuyers, homeowners, and realtors, there may be another housing bubble forming in our market. So Data Dave is going to dig deep into the housing data, let you know first if you can see a bubble forming, but more importantly, if there's any signs of that bubble bursting, causing home prices to crash from the sky. Let's let Data Dave dig in and let you know what's real about our housing market.
Okay, gang, the very first thing to determine a bubble would be floating home prices. And of course, we all know what's been going on with home prices in the Twin Cities. Since January of 2012, when the 12-month rolling average home sales price came in at just about $150,000, we've seen home prices float to $365,000, up nearly 150% and well above the peak of $230,000, which was leading into the Great Recession and the cause of the last bubble bursting. Floating prices alone, though, is great for homeowners, and what we need to look for is, do we have pressure in that bubble? And if we look at the impact that raising prices and rising interest rates have put on our market, we do find some pressure in our housing affordability index. Look, that index measures median income levels against the cost of a home mortgage payment. The higher the number, the more affordable housing is for homebuyers. So if we look at the 90s into the new millennium, affordability stayed pretty steady leading into the Great Recession. And then when prices dropped and the feds lowered interest rates to keep the economy steady through the pandemic, we saw historic affordability. But now we are left with the fallout, and there is pressure on buyers' affordability and ultimately creating questions with our bubble. But the final questions are, do we see a prick? Something to make that bubble explode and cause home prices to drop. And to find that prick, we look at 4 data points. 1, we need a drop in demand, and there is no other way to see it, gang. The demand for housing has dropped significantly. Looking at the last 3 months of sales, we are down 24% from a year ago and 30% down from 2021. And if we go all the way back to 2005, we see only in 2008, leading into that Great Recession, have we seen that number lower, showing buyer demand has definitely earned a check in that box. But remember, demand is only one of 4 items we need for that prick of the bubble. Supply is just as important, and if we look at that same timeline going back to 2005, we have the lowest incoming supply that we've seen in more than 18 years, and a long way from the numbers we saw leading into the housing price collapse. If we look at the last 3 months, we find we are down nearly the same in our supply numbers as we are for our demand. Still more of a problem for buyers than a possible prick with supply. And here's the crystal ball. If you only want to watch one number, months of supply will tell you all we need to know. Look, economists agree to have a significant price decline. There's little reason to be concerned until we are at 5 months of inventory. Going back, we see this happening. During a fairly stable housing market in 2005, we had less than 5 months of inventory. A year later, that number had jumped to over 6 months when we should have been concerned, and by April 2007, we had over 8 months of supply, a year before the official start of the Great Recession. So while our months of supply number has been climbing over the last 2 years, and we will continue to watch and report on this number every month, for now, it's well below the number required to give it a check. And finally, for those waiting for a massive pullback in pricings, what we need to watch for is distressed sellers, most notably foreclosure and short sale listings. And Data Dave has been watching this closely because if we just look at the last 3 years, we may convince ourselves that a prick may be coming. Distressed listings are up significantly over that time. But remember, the 2 previous years were pandemic years when most mortgages didn't require payments. If we go back 2 years more, well, it starts to look like we are still below normal with distressed listings. And if we go all the way back to 2005, again, gang, we see that the distressed listings today looks nothing like what we had leading into or in the Great Recession. So no check mark for the possible prick there either. Bottom line, while we may may be in a bubble, there's just no data to suggest our home values won't continue to float at least at the current levels, and most likely will continue to float higher. But there are some possible prick points trending up, and we'll continue to keep a close eye on the numbers. So subscribe and follow, because Data Dave will continue to look every month for the pricks in the bubble and make sure you are the first to know when they are coming.